gotten
I
correct.
remember one time Martin was on Blab, and again the numbers were going crazy. I was like, oh, I got to see what happened. He must be acting a fool or something. I don't know what's going on. And I go in, and a CNN reporter was demanding like an interview with him. She was like, you should, Martin. I've been watching this. It's really interesting. I would love to have a conversation with you on CNN. And he's like, no, you come on my show. This is my show. You want to interview me? We can do it right here. And she's like, okay, I'm not going to do that. But if you come on CNN, he's like, no, come on the show. And then she's like refusing or whatever. He's like, then she starts like trying to like have a moment to like tell him how bad he is. And then he asked her, he's like, I'm going to the gala tonight. You want to be my plus one? And then he like bought her a plane ticket.
Yeah, didn't you end up going out? Didn't you go out?
No,
with her?
not this one. But I just thought, wow, what a like, you know, they don't teach that in PR school. Just ask him on a date if the interview's not going well.
Breaking down the fourth wall is like my specialty, right? Like, you know, I and what Elon sort of did that to that BBC guy the other day. Like I would always ask. I remember one of my analysts who was on the sell side before joining me on the buy side, and he brought a management team to come over to this, sort of skipping ahead in my career a little bit to having my own funds. And he brought a management team over to, you know, pitch some stock or pitch a pipe or something. And I asked the CEO why he didn't own any stock in his company. And he, you know, he sort of was like hemming and hawing, like, you know, that temperature is kind of getting hot. And I said, you know, because I have your proxy right here. And I put it on the table and I said, it looks like you make $550,000 a year. That's a good amount of money. Can you promise me today that you'll buy like $10,000 or $20,000 of your stock at least? And the guy's just sort of like, you know, the most uncomfortable meeting in the history of Wall Street, you know, because I kept like hammering on it. I was like, no, but just tell me, like, why can't you afford to spend $10,000 and buy your own stock? The stock price will go up. Everyone wins. You'll show confidence that, you know, and I just wouldn't like for 20 minutes, let it go. And it was just, you know, one of these like, you know, breaking down that fourth wall. You're not supposed to do that. You know, his personal finances are up to him is what most portfolio managers would say. You know, he's allowed to not own his stock. It's really his call. But, you know, being able to sort of like, you know, cut to the chase on half these things and like, you know, address the elephant in the room is kind of the thing that I like to do, even if it's really uncomfortable or difficult or embarrassing or, you know, faux pas. You know, it's something that, you know, I'll just sort of, you know, cut to the chase with.
Well, I remember when you got arrested, or the headline was like, you had to put up like your Fidelity account or something like that had like $60 million in it. And at the time you were, I don't know how old you were, 32 or something. I mean, early 30s, very young. And it was a significant amount of money. And that was just your Fidelity account, let alone like your, you know, the touring, the pharma companies that you'd founded. Did you make your first bit of money when you started the hedge funds? And how did that come to be? Or were you already doing well just being at the hedge funds where you worked?
Oh, it's a great question. So I never made money at hedge funds. I never really made a dollar.
Working at or owning?
Both. So when I started at hedge funds, I was young and, you know, didn't really earn money, which was fine. You know, I wasn't optimizing for that. You know, I was optimizing for learning stuff, experience, good relationships. I mostly succeeded in that. I think, you know, probably messed up some relationships, but regardless, you know, did the best I could as a young guy, started my own fund, pretty terrible at doing the fund management business, you know, investing, being a good investor and being a good fund manager are kind of like pretty different things is what I think most hedge fund entrepreneurs kind of learn, you know, you can be a really brilliant investor and not manage the actual business well. And the business is to grow your assets as much as possible, provide the best sort of adjusted returns possible and satisfy your clients. And I didn't really want to do any of that. You know, I just wanted to invest. And I never took fees from any of my funds, which was very like, you know, sort of bizarre. And there were sort of technical or legal reasons for that. But so I never really made any money in hedge funds. When I started my first drug company called Retropin, which is now called Travere, this is about 10 years ago, that's sort of where everything sort of came together for me. I learned pharma by being a hedge fund person for 10 years in hedge funds, studying pharma, starting with the early Jim Cramer days where I was just figuring out what a stock and a bond was. and then moving on to, trading these things and working at hedge funds and stuff like that. And then starting my own, I really mastered pharmaceuticals. I knew everything about pharma, and I impressed a lot of people in pharma who were working in the field or working in hedge funds. And, it was easy for me to sort of start a drug company and find some really good assets. The first asset I found actually received FDA approval just a couple months ago. So I'm really proud of that. And when our company went public, I was a millionaire.
How old were you?
It was 2012. So I was born in 83. So I guess I was 29. And I was a CEO of a publicly traded company. And the market cap of that company, like I said, now is, 1.5 billion roughly. And the drug got FDA approved. So I'm really happy about that. Like so often in biotech, people start companies, they kind of extract some equity value out of them as they go public, and then the company's drugs don't work and they kind of move on. And there are people that have like coasted in biotech doing that like every 3-5 years. I'd name some names, but it doesn't matter, and getting a drug FDA approved. And for me, kind of on my first try was, sort of like a very, it's a very like nice feather in my cap. And I'm happy for the people that are now getting this prescription for this kidney disease. Really delighted by that. But it was a lot of fun to see that. So when people ask me like, where'd you make your first million? I made my first like 25 million all on the same day. It wasn't like, okay, you make, like one of my great friends started off making, he's a great story. And one day maybe you'll have him on this podcast. He started off trading sneakers, and he was like 13 or something. And then he started trading cars, and he ended up trading stocks, and he sort of went from $1,000 to 5,000 to 100,000 to 1 million to 5 million, et cetera, et cetera. And, that road isn't what everyone does, right? Like some people, I was like literally almost like starving, and like broke, trying to get that big win, and it came through.
And so you said a couple of things I want to quickly clarify. You said you didn't make much money in investing because you weren't really good at or interested in the fund management. But presumably, if you're good at or interested in the investing side, you would still generate returns. So what was it like? Didn't do so hot on the investing side either, or what happened there?
Yeah, I had sort of like a mix of issues. Like when you run a small fund, you have like costs and stuff like that. So you have startup.
How big was the fund?
I had about 8 million, ever since I started. So like, you just can't like, even with good investing, you just kind of can't do that well with respect to returns if you have other costs and things like that. And, we had like all kinds of like issues happen along the way that led to that prosecution and stuff like that sort of limited our ability to do really well financially. And again, we didn't take any fees either because again, we had this sort of big issue that came about, and we just decided to not take fees at all. But in the end, our investors did fairly well. The record shows that our investors all made money in our funds. So I was really happy to deliver that. But, along the way, there were a lot of twists and turns and hiccups they're not worth going into. But hedge funds for me were kind of like just sort of like a roller coaster of issues that were just over, and over again, kind of like various like, unexpected twists and turns that didn't really add up to profit. Some people at hedge funds, like if you get off to like a good start for your first like 3 or 6 months, often you can get this momentum of raising more capital, and you get this like virtuous cycle. But you can also go in the other direction where, if many funds are started by good investors and they end up failing, and those investors sort of come back and take a few years off and start a fund again. Hedge funds have like the shortest lifespan. If you look at the top hedge funds from the 90s, almost none of them exist today. And I think of those like top 10 hedge funds of all time, like 5 were shut down by regulatory intervention. So like, it's a very hazardous job. There's a, 10% chance of like, going to jail being a hedge fund manager. It's a really, kind of dangerous job to be in. And, you're dealing with the markets and you're dealing with representations to investors. Just how to mark privates, right, is kind of like one of these like real debates. I know a guy who went to jail for that fairly recently. Anybody looking into your books can basically say, oh, well, you marked this too high. Therefore you're defrauding your investors for charging them too much. Well, you marked it too low. Well, now you're defrauding them because, you're preferencing the other investors who are coming into the fund. So, you really can't win. It's a very tough business. You don't build any actual lasting value. As you know, almost no hedge funds have gone public. So it's just kind of a crummy business in general. And like, I don't recommend anyone kind of get into it unless they're so interested in stocks that they can't, help but like spend their whole time looking at stocks. Like Kramer back then, Kramer's like a stock addict, right? So this guy, again, I consider him, not quite a friend, but like I have a fond memory of working with him. I mean, he is like a drug addict to their drug. He is like that to securities. Like he cannot get away from it. There's nothing he loves more in the world than stocks. And you think about people like Warren Buffett and say, maybe that's kind of like them. And the average person who wants to get into hedge funds, they wanted to get into it because, I can make $10 million or I can make $50 million in a year. Wow, look at that. Jim Simons made $1 billion. I can be like that. That sounds great. And, that's a terrible, terrible, terrible way to look at it, right? If you wake up in the middle of the night thinking about S&P earnings estimates, you should be at hedge funds, right? But if you don't care on a Sunday, what the news is going to be on Monday in the stock market or what, your favorite company CEO is doing that night, it's not for you. And I think there are people that the hedge fund industry has grown so much. People come to finance not understanding that in the 90s and the 80s, the only people that were in hedge funds were people like Jim and Buffett and people like that were just like so intensely, insanely possessed by the gyrations of the market. And if that's not you, it's kind of not a good industry. But for me, I was sort of intensely possessed with pharmaceutical companies and pharmaceutical assets, which are drugs and medicines. And, it was actually a better fit to do private equity, kind of style investing where you actually buy whole medicines, whole companies. That worked really well for me. And I've seen a lot of people in hedge funds sort of transition to that model of, well, if I can buy 5% of a software company, why can't I buy 100% of a software company, right? That makes more sense to me. And for me, you lose that. Like one of the things I was very bad at trading and investing was kind of that impulse, right? Where you have to have this insanely good discipline as a trader. And my partner had this really, really great discipline. I didn't. So I could value a security as good as anyone. But when it came time to like executing and actually deploying capital and risk management and stuff like that, it was much harder for me to be good at that. So when it came time,
what does that what does that mean? You're not patient. You
Sure.
wanted the dopamine hit. You wanted the dopamine
every
hit.
one of those things. Yes, and
You're just like you have normal anxiety like a lot of people. Is that what that means?
I think that like to ask somebody to manage a portfolio well is one of the most impossible tasks in like human psychology because and there's this great book. I've gotten better at it over the years for what it's worth. And my personal trading is as paradoxically like soared in profit as my, I basically couldn't do that in private investing. The hardest thing to do is really to fight 2 or 3 different, for me, specific demons that are psychologically based, but everyone has their own demon. For me, we're avoiding this desire to double down. So the market is like this really tough psychological battle where you're constantly going to be humbled that your opinion is wrong, that your thesis is wrong, that this stock is not cheap. You're wrong. It's not cheap at all. And you got to sell it. And that's really hard cognitively to embrace every day. You can embrace it every now and then. Oh yeah, obviously I bought this crap stock and I'm wrong. But when you're right, you do get that dopamine hit and you don't want to confront that loss of the dopamine hit, or even worse, the acknowledgement that you were wrong. And you're going to be wrong like 40, 50% of the time at best, say 35, 40% of the time. And most people don't want to be wrong ever. So the desire is sometimes to double down and just say, no, I know I'm right. This is an even better opportunity than it was before. If you keep doing that, you basically will go bankrupt. It's like the fastest way to go bankrupt. And, I've learned that trick, a couple times now. And I think that, I've gotten better at sort of not doubling down, but to be a really great trader, you got to not just not double down. You also have to get out, before all the damage is done. And so I've started to do that well too. But, these pains are not pains your investors want you to learn on their dime, right? They're pains you have to sort of, be ready, when you start your own fund. So I sort of started my fund too early and stuff like that. But I think that I wouldn't change a lot in the sense that when you have a fund, you learn more about your industry. If you do it right, I think you learn more about your industry than any other sort of job other than actually being in that industry. So You learn a ton about what Wall Street wants. So let's say if you're a software analyst, it's really great to then have a software company because you know exactly kind of what the exit looks like and what like public company investors want to see. And the same thing works in biotech. And in biotech, to handicap like, oh, will this company or stock be a good stock? Well, you got to figure out, will this drug be a good drug? And that's the exact same skill set you have to do when you're CEO. So you have that like, crossover that's happening quite a bit more in biotech. I've seen that. It doesn't happen so much in tech. People who invest in tech generally don't want to be operators. And the tricks that you have to learn on the operating side in tech are very different from biotech. In biotech, you can actually like learn, pick up most of the operating stuff from being an investor. Whereas I think in tech, like, being an investor in a software company certainly doesn't make you a programmer. So,
and that's what I was going to ask you, because you were like, well, I started a pharmaceutical company because I loved the asset and I learned through it through finance, which is way different than like, for example, my friend Kara started this company Hint, which does like water, because she was like, my skin was bad and I didn't want to drink Gatorade or Coke anymore. So I like went and boiled fruit peels and made this fruit water that's like tastes good. It's good for you. And we grew from there. Your founding story was like, oh, I found assets that were interesting. Like that's like foreign to me. You know what I mean?
Yeah. So like if there was a company, for example, my first hedge fund, we bought 10% of this company, publicly traded company, and they had bought this asset from Bristol Myers, the major drug company in New Jersey. And Bristol Myers spent like $50 million developing this drug, and they quit. They basically said, this doesn't fit our portfolio. We're not really going after the disease they were trying to go after was hypertension, which is very boring and does not need another medicine. There's like 60 hypertension drugs. There does not need to be a 61st. And they just quit on the drug. There are people who have like really bad resistant hypertension and so forth. So I really like this asset. I like the way it worked. And after Bristol Myers quit on it, the publicly traded company in the financial crisis, they merged with another publicly traded company. So I went to the publicly traded company. And again, the only thing I have is a hedge fund moment. And I said, let me buy. And nobody's told a story, by the way. So this is a good time to tell it, because it's really, it's basically a story about how we went to this company with $2 million and turned it into over $1 billion. Which is kind of remarkable, but people do this in pharma every day. And my friend, and at the time it was actually my biggest investor, Vivek Ramaswamy, he's now running for president. He basically took our business model and supersized it. And again, who influenced who is a matter, left to history. But the point is, we went to this company that had the license from Bristol, and they weren't doing anything with it. And we said, listen, we'll take this, we'll find investors, we'll build a company around it, and I'm going to figure out how to make this work. And they said, okay, sure. We got this asset sitting here doing nothing. If you pay us $2 million, we'll send you the $2 million. Now, we sent them $1 million, which was really catastrophic, because you never want to sort of go back on your word. But it was really like a dire circumstance where I forgot what happened exactly, but we just couldn't come up with money. And it was like, we sent them $1 million and they were like, what the fuck? You can't do this, and I was sort of like, geez, this is a huge embarrassment and a huge problem, but you're just going to have to give us like 30 days or 90 days. And, we worked it out and we were able to give them the second $1 million, but it was like this colossal embarrassment right at the start. And, shit does happen, but, it ideally shouldn't happen like that. And again, really embarrassing and tough, but we got them the $2 million. And we decided, I sort of did all this research and said, instead of hypertension, we should go with this rare kidney disease called focal segmental glomerulosclerosis. And if you just go on PubMed and you have the willpower, you can learn a lot about medicine and you can dive in and really
PubMed just being like a database of articles.
Yeah, PubMed
and
is
patents, I guess.
Yep, PubMed is the government database of all scholastic biomedical literature. So 36 million papers. If you sit there long enough and you have the passion, you can become a billionaire. It's just a matter of sitting there and sifting and sifting and sifting, which most people don't have the patience, desire, or willpower to do. But every single biomedical innovation is logged in on PubMed.
And you were sifting for what? What were you looking for when you went on PubMed?
Yeah, you have to put the pieces together. So this drug was an endothelin receptor antagonist. And what does that mean? It inhibits a protein called endothelin and its function. Well, what will that do, right? You have to decide, you have to learn, where is endothelin expressed in the body? How does it work? What does it do? If I stop endothelin from working, what benefits will that have? What problems will that result in? And you have to look at the history of, other companies have tried this. What have they seen? What have they discovered? And what's interesting about pharma is that you think that these companies cover the waterfront, but they really just prod and poke a little bit. There's actually probably 10 diseases that this drug could be beneficial for. And I made a list of those and I said, okay, well, which one of these is going to work for sure? And there are companies that like got half the answer and stuff like that. And you just have to keep poking. And we found like these handful of diseases that really made a lot of sense. Now, the problem was nobody in Wall Street really liked it. It was very, kind of early, there was this sort of tough problem of if you reduce the amount of protein in the urine of a patient, does that really save their kidney? And I thought I convinced everyone that I could reduce the amount of protein in the urine, which was a very big endpoint to me, but not as conclusive as, okay, am I saving their lives? Am I preventing dialysis and kidney failure, which is really the so-called hard endpoint. So I had the soft endpoint that like seemed like almost certain I was right. And I was starting to convince companies like AbbVie and Vertex and other like big biopharmas that, I was onto something, but nobody wanted to write a check, so I basically got one of the management teams that I used to deal with on Wall Street to invest. And I slowly kind of cobbled together some money, met folks like Peter Thiel and others to try to sort of get some investors, did a reverse merger.
What's Peter Thiel like?
Peter was great. It was 10 plus years ago. He had never done pharma. So we got to meet, and this was going to be basically like his first pharma deal ever. We didn't end up doing the deal, but it was a very funny thing because like there was this East Coast versus West Coast mentality. As a Wall Street guy, he was, he's obviously, one of the top VC type guys. And this is a time where like he had Clarium, their founders fund was just getting started and stuff like that. And, the wheeling dealing, like Wall Street sort of style of like, oh, we're going to do a reverse merger, which is basically kind of like a SPAC with no money. It's like even worse than a SPAC. You do the listing and then you raise the money. But it's a way to go public, and we did it. And he was like, you can't go public in a year or two. And, the reality is you kind of can, especially in biopharma, where the assets are like these very modular systems. They're not like a base business that has X dollars revenue and is growing at X rate. These are like, okay, this asset's worth something dead or alive. In other words, if it's being developed or not being developed, it's worth something. Especially with the right business plan, it could be worth a lot. So anyway, we decided go public. We raised some money. We started doing clinical trials. The trial worked, and the rest is history. But it took, it takes hundreds of millions of dollars to develop a drug. Again, the value of the company is 1.5. The value of that drug specifically is probably around 1 billion. Again, whether it actually achieves the sales goals or beats them or disappoints, we'll see as the drug launches. And I'm rooting for the company. So
you didn't even get the drug in this example. You didn't get the drug to the point where people were buying it or using it. It was, you made money off just the fact that this will exist hopefully in 10 or whatever years.
Yeah. And this is where, a lot of people don't know my story about medicine. A lot of people think that I take medicines and raise prices. Well, this drug was barely in human beings. It had been in like 30 or 50 people up until that point. And, I made most of my money in sort of developments in environment on the research side. So, this is a drug in clinical research. So no, it's not, it hadn't been FDA approved. It would take 10 years to get it FDA approved. So it was a long marathon of running studies, getting the evidence, running more studies, getting more evidence, and continuing that process. And, as we started to do that, the value of the company increased and people said, okay, I think I get this. And then as the data came in, now it's FDA approved. It's called Filspari. I named the drug sparsentan, gave it its first chemical name. And, I'm so happy it's FDA approved. Now I left the company halfway through this process, so I should acknowledge that. But, all the same plans and so forth, continued.
Did you own most of it at the time, or what was that? And did you have to divest when all the shit went down?
So I went from 90, when we started it, to 50. When we're public, I think we had around 40 or 50% after our first financing, down to 30, after our second financing, down to 20. So at the time of our IPO, we when you do a reverse merger, you often don't get on NASDAQ. So we did an IPO on NASDAQ in 2014, and the company was worth like 300 or 400 million, and I owned about 15, 20% of it. And again, this is sort of like my first wealth ever. But the funny thing is, as you guys maybe know, you have a situation like that, you actually don't have any cash.
Yeah, you're not liquid.
Yeah, you can't sell it.
So, I've got millions of shares of the stock, but, I'm sitting there saying, okay, well,
you're like, how am I going to buy this Wu-Tang album?
Yeah, exactly. Well, but well before that, you think about like, how am I going to buy this $5,000 a month apartment and go to the $7,000 a month apartment, which is like a very funny discussion for somebody that, has 50 or $100 million of stock value. And I would go to these banks and say, listen, can I borrow 5%, of my money, of my stock value? And they would say no. And, I'd say, why not? And they'd say, well, it's a new stock, it's kind of, still, a little bit unseasoned. You're the big shareholder, we're just not comfortable with it. And like sitting there like, oh my God, this is insane, because I don't want to sell my stock because it sends kind of a bad signal to the market. But I don't want to, also be starving. So it was a very like funny thing. And I don't want to be one of those greedy CEOs that has, an insane salary, where you don't need it. So it was very just sort of a funny circumstance.